Hello and welcome to the Blockchain Academic Podcast by the Crypto Research Report, decrypting the world of crypto assets, focusing on insights and analysis from the top minds in crypto today. Brought to you in partnership with the premium sponsors of the Crypto Research Report, Coinfinity and Falcon Bank.
Thank you, Jonas Gross and Manuel Klein, for joining me today to discuss stablecoins and central bank digital currencies. Jonas Gross is at the Blockchain Center at the Frankfurt School of Finance and Management in Germany, and Manuel Klein is working at FactSet. So to go ahead and get started, I'm just going to have Jonas take the floor, introduce yourself, and then Manuel after that.
Exactly, so perfect. Thank you a lot for the invitation. I'm very happy to be here today. So my job at the Blockchain Center of the Frankfurt School of Finance is basically I'm doing lots of research, writing research papers with respect to current trends in crypto assets and blockchain technology. So this, for example, covers projects like Libra, which also has announced an update just the last week. And also central bank digital currencies is one of my topic. And I'm also working for a German government-funded project where we implement a blockchain platform for the German industry. And besides that, I'm also working, I'm doing my PhD with respect to central bank currencies and also stablecoins at the University of Bayreuth. So I'm actually part of the academic world where I'm doing my PhD and writing the research papers, but also have some more practical insights from the Frankfurt School Blockchain Center, where we also implement DLT-based platforms.
Wonderful. And Manuel, you mentioned you were at FactSet. So can you just tell us a little bit about what FactSet is?
Yes, so professionally I work at FactSet. It's a data or financial data service provider. We offer the data, but also the applications for which you can consume the data, and also analytical products. And I work as a consultant helping my clients to use our products and software and data in their workflow, especially in the asset management space. However, this has not so much to do with everything that we've been working on and that we will discuss today. But apart from that practical experience, I am really interested and very actively involved in an NGO, which is called Monetative. It's part of the International Movement for Monetary Reform. And I have been in the core group for now like 5 years. And started to get interested in the flaws and the problems that the current monetary system and the current money system, the design of the money system, produce. And so for more than 5 or even 6 years, I'm really interested in the functioning of the current money system and potential alternatives. And that's how I also stumbled across blockchain technology, crypto assets, of course, also some 4 or 5 years ago. And ever since I've been writing articles, doing research on the current money system, but also on alternatives. And therefore, of course, also on CBDC, on monetary reform topics, such as sovereign money or full money reserve, full reserve money. And that's why I also write these articles about the current movements in this space.
Excellent. Well, thank you so much for both joining me today. The main paper that I wanted to discuss with you is a Medium blog article that you made called "How Will Blockchain Technology Transform the Current Monetary System?" And this was a paper that you co-authored with Professor Philip Sander at the Frankfurt School of Finance and Management. And just to go ahead and jump right into this paper, you discuss stablecoins and CBDCs. Do you consider CBDCs to be stablecoins? Jonas, maybe we can start with you and then follow on with Manuel.
Sure. I think this is actually a very interesting and relevant question because there is lots of confusion also going on in the literature about the terminologies. So from my perspective, I would argue that it depends if a CBDC is actually considered to be a stablecoin, because I mean, what stablecoin implies that this is kind of a DLT based token, which some mechanism to stabilize the prices. And in the case of CBDC, this would probably be a one-to-one exchange rate to actually existing in fiat currency. So we would have a stable form of money, but if it can be called a stable coin and is therefore a cryptocurrency, depends if DLT is actually used as a technological basis. Because when we look in the CBDC space, just the Chinese central bank got their CBDC live also just recently, and they said that the platform is partly based on DLT. Therefore, I would consider this a stable coin. But there are also some CBDC initiatives out there which are not focusing on DLT. So this is just one technological choice. And therefore, I would say it depends if DLT is indeed the underlying technology, which in my perspective, I argue it is, but it's not a necessity to use DLT.
All right. So I would argue a little bit against that, but I do understand your thoughts, Jonas, but I would say it's basically the question whether or not the CBDC itself is the coin, the token, the asset, whatever you want to call it, or if it is just backed by something else. So think of, for example, PayPal money, which can also be labeled, for example, as PayPal tokens, if you want to say. And they are also backed one-to-one or 100% by bank deposits. So you wouldn't call PayPal tokens a stable coin. However, when you look at it economically, it might also, to my mind or to my opinion, be labeled as that, or the economics behind DLT-backed stablecoins, the DLT transferable stablecoin, or for example, this PayPal token would be basically the same, because they are both backed by some other asset, which would either be bank liabilities, so bank deposits, right, or central bank money, which could be central bank reserves, or for example, also physical cash. So I would say you would differentiate CBDCs and stablecoins. And going back to your question whether CBDCs are also stablecoins, I would say that it depends on the design. So either there's an indirect approach for a CBDC through some other intermediaries. You would call this a synthetic CBDC. So you would have some token, for example, the stable coin that is backed by central bank reserves, right? So you would have an intermediary between the end customer and the actual central bank reserves. But there would also be a direct approach possibility where the customer actually holds the CBDC as an asset itself. And so then I would not argue that this is actually a stable coin, because it is actually the asset that might back some other coins that then could then be labeled as stable coin. So I would say it basically comes down to the design principle, whether or not you want to have an indirect CBDC where some intermediary has, for example, central bank reserves and backs the tokens that it issues by these reserves. Then you would have a synthetic CBDC, and then you could label it basically as a stable coin. Or if you have a direct approach, then I would not call it a stable coin, but then it would be a coin itself, for example. Yeah. So which type of stable coins do you mean? I think there's I sadly forgot the name, but I think there were some projects in the past that tried to run a stable coin by an algorithm that automatically stabilizes it.
Basis, for example.
Yeah, exactly. But to my knowledge, they all failed, because the problem is it's like a Ponzi scheme, because they are reliant on future inflows, so that this algorithm actually works. When more money is flown into the protocol than it is flowing out, it actually worked quite well. However, then there was always a point in time where people withdrew their money, and then the algorithm collapsed, and the stableness of this coin totally collapsed as well. So that's my to my knowledge, they have all failed. The rest of the stable coins, as far as I know, are either backed by bank deposits, by other assets. So, for example, Libra wants to back its coins by government bonds, or even by crypto. I mean, we also have stable coins that claim to be stable. Again, and then of course you would have to ask against what are they stable, but they are backed by other crypto assets. So correct me if I'm wrong, but to my knowledge, the projects that were not backed by anything failed as a particular stable coin.
Jonas, maybe you know of some projects that have worked that don't have backing. To my knowledge, I also don't know of any that have worked.
Yeah, I actually agree with Manuel. So what the algorithmic stablecoins are actually concerned, most of them, also Nubits was one project which really, tremendously kind of failed. But still, I mean, it really, again, it's interesting to see that all of us three have, even if we are all in the crypto space, has different ideas about what stablecoins are. The ECB in a publication also considered Nubits or bases in stable coins, but I mean algorithmic stable coins. But I actually see the point Emmanuel wants to make here. And just one to your comment, the Meltzer, with respect to DLT, I also agree that, and this was also the point I wanted to mention, that if the token is DLT based, I would consider it a stable coin. However, with respect to CBDC, I'm not 100% in line with current CBDC projects you mentioned, because we have actually a few projects out there which will be DLT based with respect to CBDC. So most of them are implemented by smaller central banks. So for example, the Marshall Islands, they will introduce the SOF, so CBDC in this year, and this will be completely DLT based and with the Algorand DLT basis. And also the Eastern Caribbean Central Bank is launching a pilot. So of course this is like a smaller countries, but they use DLT. And also the Swedish Riksbank and also the ECB in their recent publications about retail CBDCs, they actually mentioned that they will at least try a retail CBDC based on DLT. Of course, this is not a final decision if there will be a CBDC or if it will be DLT based, but I think that the current developments are really going into the direction to really explore DLT and to consider DLT as an underlying technological basis.
Yeah, it's interesting that you mentioned the Marshall Islands and the Caribbean project, the BIT stablecoin, or sorry, the BIT central bank digital currency. Regarding the Riksbank, the Swedish e-krona, I actually reviewed their recent reports, the report 1 and report 2 on their e-krona, and it doesn't state that they're going to use DLT. It says something along the lines of, we are considering involving other agencies in the validation, but we have not come to a final we have not come to a final decision regarding this yet. So maybe you have more information. We don't need to go too much into the weeds. I hope that one of these projects is successful with implementing DLT. And when I say DLT, I really hope to mean multiple nodes making decisions, even if it's in a private network where we can't see the transactions. As long as there's more than just the central bank involved, then I think that adds in some of the benefits of decentralization that even systems like Hyperledger or systems like Algorand can provide. So that's very exciting space to go into. And going, sorry, go ahead.
Yeah, I totally agree.
And moving on into the next section of your paper, you also discuss how wholesale CBDCs are going to widen the access of banks and non-bank financial intermediaries to the central bank. And you don't exactly use the words correspondent and respondent, but from my understanding, you are saying that wholesale CBDCs could potentially put an end to this respondent banking and correspondent banking system. And I think that that's quite interesting because I don't think a lot of people understand how that works. But sometimes, when you make a transaction, a foreign exchange transaction, your bank doesn't actually do that transaction directly. They're going to have to first send that transaction to a larger bank who has accounts at the central bank, and then that transaction can be processed. And the further you are away from the central bank, the more fees and intermediaries come in between you and settlement of that transaction. So maybe if you want to talk a little bit about how you think that the the central bank digital currencies might widen the scope for all banks.
Well, I think you already mentioned it exactly right. So what my understanding of the wholesale CBDC would be that actually the interbank payments that are currently processed via different types of payment systems, TIPS, RTGS systems from all over the world's central banks, then FedWire in America, and whatever you want to call them, most of them are restricted to certain larger banks that have their accounts at the central bank. And smaller banks usually hold accounts with those bigger banks and then have to settle all the transactions that need to be settled in central bank reserves through these bigger banks, to these larger banks. So you said there's fees involved, but there's also, for example, credit risk involved. So if you widened the access to central bank reserves through such a wholesale CBDC, which would make a lot of sense and which would be a lot easier because the technology would be easier and it would be faster and probably more scalable than the current systems, then you could open access to the central bank balance sheet to more institutions than only the larger banks that currently have it. Especially, you could also open the access to other institutions besides banks. For example, to fintechs. The Bank of England already, I think 2 or maybe even 3 years ago, started this process by opening its real-time gross settlement system that is used to transfer the central bank reserves between the banks. And they opened the system for other players such as fintechs in order to let them participate in the payment sector with to strengthen the competition between payment service providers such as fintechs or other payment service providers and banks. So a wholesale CBDC could actually help to open the gates for other institutions as well and provide more competition in the banking sector and especially in the payment sector.
Thank you. Jonas, did you want to add anything to that?
Yeah, actually, Manuel explained it pretty well. What I wanted to do is actually to stress that this wholesale CBDCs is also not just a theoretical concept, which sounds nice and can lead to efficiency gains and also lower credit risk, etc. But this is really also something which is heavily researched at this point, and also major central banks, as the ECB, also in a prototype with the Bank of Japan, is researching just an wholesale CBDC based on DLT for more than 3 years now. So you see that also some very big and major central banks are taking this very seriously in their considerations if they should go into the territory of a wholesale CBDC. And therefore, this is something we could potentially see in a few years also in the Euro area or some other countries.
Interesting. And touching on that point of risk, your paper also discusses moral hazard. And you say that on the one hand, the current financial system where we have deposit insurance, this can create moral hazard as banks take on too much risk. And I wanted to go a little bit deeper into the way that works. So essentially, banks accept deposits on the behalf of their clients, and then they go and invest those deposits in different assets on the market. And if they invest in extremely risky assets, then there's the chance that they could lose the depositors' money. So effectively, what happened was government stepped in and said, well, we're going to insure those deposits. Now, I wanted to go ahead and ask you, is that your basic understanding of the moral hazard problem, that the banks are aware that the government will step in as a kind of saver of last resort, and then they will bail out the banks instead of making the clients take a haircut and lose their deposits? And how do you think that the CBDC movement will reduce moral hazard and reduce the need for deposit insurance?
I would say you're right, more or less. However, I really want to stress the first part that you mentioned, where you said that banks take the deposits of depositors and then invest these into potentially risky assets. I think from hearing that, it might be that there's a little bit of a misunderstanding how a commercial bank actually works, because commercial banks are not simply intermediaries that take deposits and invest these, for example, into loans. So basically take deposits and hand these deposits to other creditors that want to take out a loan. However, banks create the money by buying securities, for example, credit contracts, and therefore they create money whenever they make a loan. So I would argue in a little bit different way that in the current money system, in which commercial banks create the majority of the money supply, in Great Britain it's like 97%, in the Eurozone it's like 87%. And in this money system, you have rather fragile money, because banks create it when they grant a loan, and when this loan is going not so well, and then the creditor cannot pay the money back, then the backing of that money is at risk. The same applies when a bank buys securities such as assets, bonds, and so forth. So they then credit, or well, they would debit the account of the seller with some numbers, and these numbers are actually liabilities on their balance sheet. So the seller of the asset holds then a liability of the bank and has sold the asset to the bank. So that's again rather technical, but I think it is quite important to tell the story this way, because what you have as a bank customer in your account is basically a liability of a commercial bank. And this liability is, you can think of as a voucher on the payout of physical cash. However, commercial banks only have a fraction of their liability side backed by physical cash. That's the very well known and understood risk of a bank run, where a lot of clients actually withdraw their money, and then the bank does not have that physical cash in their vaults. Okay, so now when we introduce, so just to make it clear, there's a inherited fragility of the current money system, in which banks create the money by granting loans, and especially when they know that there is a deposit insurance scheme available, and that the government will bail them out if anything goes wrong, there's a moral hazard emerging, that they can actually either buy very risky assets and therefore create the money in the accounts of the seller, or also grant very, very risky loans, which we have seen also, for example, before the great financial crisis in 2008, where they have given out credit of around like 130% of the value of the house that was taken as collateral for the mortgage. So there's a lot of risk taking in the banking sector, because they know they will be bailed out, especially also because they know that they can sell the the loans or collateralize, collateralize them and sell these packages, such as collateralized debt obligations or mortgage-backed securities and so forth. So there's a long tail when you look at or when you understand and analyze the current money system. And now CBDC comes in. And then that was initially the idea of James Tobin in 1987, where he proposed his idea of deposited currency accounts, which basically is a retail CBDC. Yeah? So it's not a new idea. It's just that this new technology, the DLT, has brought up all these old ideas again, right? So Tobin actually said that this moral hazard is a big problem, because the banks know that in times of crisis they will be rescued by the state. And then he said, well, now let's offer the possibility to the end user, to the customer, to actually hold central bank money directly, which is by definition a risk-free asset, because central banks are the only institutions that can create this currency with a limited amount, because there's no competition, it has a monopoly, and because it is backed by states and tax money, and that is per definition the most safe asset you can hold in an economy, right? So he says then, well, now let's give the bank customer the opportunity, or all the non-banking institutions that don't hold a banking license, that let's give them the access to the central bank balance sheet, and let's give them access to safe money. Now, banks would now always have the fear that the bank depositor actually withdraws its money into not only physical cash, but now also digital cash, or into his or digital currency, central bank digital currency, or like Tobin labeled it, into his deposited currency account. Okay, so this fear for a bank is, of course, a very disciplinary, or it causes a disciplinary effect, because the bank has this inherited fear that this money could flow out, and therefore by this disciplinary effect, strengthens the competition, strengthens the well-made decisions of the bank to issue new money or to create new money, and therefore reduces the moral hazard. That was basically the idea of James Tobin, that now also comes out, or that would come out if you introduced a CBDC.
Yeah, maybe to just very, very briefly add a few aspects on this. So I think the most important point is that it's really a matter of claim, who has a claim against whom. So if we think about cash, this is actually the holder of cash has a claim against the central bank. If we have bank money, bank deposits is a claim against the commercial bank. So this is, even if it's on the paper, it's both the euro, it's a different claim to a different party. Therefore, of course, it's a difference if you have a claim on the central bank, which can actually provide unlimited liquidity in case of emergency, or if it is on bank, because we know that bank can default. And I was actually very shocked when I talked to a few bankers about this, and I actually had to kind of explain the difference between bank money and central bank money with respect to the degree of riskiness, because they said, well, we don't have any risks because governments and central banks will save us. And this is actually something we also discussed, but I think this actually stresses how how weird this actually is, because if a banker actually says this, I mean, that shows how relevant moral hazard is, and that we kind of need, from my perspective, a digital means of payment, which would be a CBDC, which is a claim on the central bank, where we can conduct digital payments with, and are not subject to a very high default, or not a very high, but in some circumstances a high default risk, as in the case of commercial bank money.
Okay, so just to make sure that I understand both of you correctly, and thank you for digging into the details on how this actually works. Now, this would only apply, the reduction in moral hazard would only apply in the case of retail CBDCs, if I understand you correctly, because if they only create wholesale CBDCs, and then we're still using bank money in the economy for households and individuals, then the moral hazard would still exist. Am I misunderstanding, or is that correct?
Well, you could argue that way, but I think since we already touched upon the question whether or not CBDC is a stablecoin, and that I introduced synthetic CBDCs, I would go a little bit beyond what you've said and say, well, if we had a wholesale CBDC and then opened up the access to the central bank balance sheet, for example, to other players besides commercial banks, for example, e-money institutions, for example, other payment service processing providers, they could actually then back their liabilities 100% in central bank reserves, or whatever you want to call it, when we have a wholesale CBDC system. Yeah. And then you would basically have a synthetic CBDC, and therefore you, as an end customer, as a non-bank, could also have, with an intermediary in the middle, access to the central bank balance sheet, and therefore also have access to CBDC. And then you would also get these disciplinary effects, because then you would actually, well, open the access for non-banks to the central bank balance sheet, and that would more or less, and that I think is very important to say, more or less be the same as a retail CBDC.
Interesting. Okay, well, that's all very relevant, and it's very interesting that these topics have already been discussed in the literature, such as Tobin's 1987 retail account scheme that you mentioned in your paper. And another thing that you mentioned in your paper was a paper by Irving Fisher on sovereign money. Now, Irving Fisher was writing papers about 100 years ago, so this paper must be quite old. Can you describe what is sovereign money? Is this kind of like the Vollgeld initiative that was in Switzerland last year?
Exactly. It goes into this direction, but since we already have been very technical and very detailed, I would keep that up and also stress that Irving Fisher coined it as 100% money, and what currently NGOs are campaigning for, which is Vollgeld, or sovereign money. Well, for those that don't want to get into the nitty-gritties, the Chicago plan and the 100% money of Irving Fisher looks the same as sovereign money. However, it's a little bit different. But I'm not too sure whether or not we should go into this enormous detail here, because then we would have to really get into the details of the current money system with central bank money, and the different possibilities to transform that. However, coming back to your question, Irving Fisher basically understood that the crisis in the 30s, in the 1930s, so it's it's a really long time ago, that this crisis was actually created by enormous risks being taken by the commercial banking sector, and by enormous credit creation, so money creation from the banking sector into non-productive sectors, especially for speculation in the financial system. So when you create money as a bank for non-GDP relevant transactions, this is always inflationary, because if you create a new unit of money but don't create a new unit of value adding goods and services like you would do in the real economy, you always inflate the prices. And this is exactly what happens always before financial crises appear, and that's exactly what happened also before the Great Depression in the 1930s. And Irving Fisher understood this and said, well, what we need to do now is we need to forbid commercial banks to create money, and take that responsibility for new money creation back to the central bank, where it was for centuries before well, commercial banks actually found this magic money tree to produce money, even though they don't have it in their wallets. Okay, so what he said then, well, let's take back the control of the money creation to the central bank. And now this idea of well, taking back the control of the money creation to the central bank, this can also be coined as the Chicago Plan. And now this idea also comes up in the literature. It was, like you already mentioned, it was campaigned for of NGOs in the last couple of years. There was a Vollgeld initiative in Switzerland to introduce such a system. And now that we are discussing CBDCs, this issue appears again, and it is debated in the literature as well, because if you introduced a CBDC, a retail CBDC, and then massive amounts of funds flew out from the bank money system into the CBDC, then it could actually lead to 100% system like Irving Fisher had proposed. Okay, it will not lead automatically to a sovereign money or a Vollgeld system, because, like I said, there are some technical differences, but you would have like 100% if you thought it into the way of that 100%, like all of the bank customers transformed their money or withdrew their money that they now hold in bank deposits into CBDC, then you would actually have a 100% money system in which all the funds are either backed by central bank reserves or actually are directly central bank reserves, which would be retail CBDCs. Okay, so that's the fear, so to say, that a lot of researchers and central bankers have, that enormous bank runs could emerge and then could actually disintermediate the banking sector and lead to such a system if you thought it in a very, very extreme way, that basically all the bank customers withdrew their money.
Yeah, I think you covered most of it, Emmanuel. What I actually like is that crypto assets as Bitcoin brought these very, very old ideas back to the surface, right? So I mean, even with that we are discussing this topic today together really shows how this kind of very old ideas really are very relevant again today. And maybe also one fun fact to the token idea of having an account with the central bank, and this is just a legal one I find very intriguing, is that in Germany, actually in theory, you could introduce such account-based central bank accounts, account-based retail CBDC just actually overnight, because there is a legal mandate that the German central bank is allowed to provide bank or central bank accounts to actually every citizen. Okay, I think this is a very nice and interesting aspect also from a legal point of view.
They have the decision over whether or not they want to issue these accounts. So I think you're absolutely right, Jonas. But there was a very interesting lawsuit, I think in 2011, where a big insurance company wanted to have an access to the central bank balance sheet and therefore have an account at the central bank, because they feared that commercial bank money was too fragile for their transaction and therefore wanted to have an account at the central bank. And the Bundesbank, the central bank of Germany, actually neglected and said, well, we don't want to, and we have the decision over whom we want to give access to our balance sheet, and we decide that we don't want to give you access. So they still have the power to decide over the access.
Yeah, true.
But maybe adding one more point, because I think what you mentioned, Jonas, with regard to crypto assets is very interesting, and I totally agree with that. And maybe real quickly, I really quickly want to come back to the difference between sovereign money and 100% money, because when you look at crypto assets, I think this is a great way of explaining the difference. So sovereign money, what that is, basically what these NGOs and what the Swiss initiative, the Vollgeld initiative, wanted, was basically a Bitcoin-like monetary system in which you would have an asset as a money. Okay, so currently we have a liability-based money. So we have claims on institutions, and we use that as money. So we have commercial bank money, commercial bank credit, and that is the claim on commercial banks to pay us out in physical cash. And when we hold cash, just as Jonas explained it correctly, we have a claim against the central bank. Now, Bitcoin has a completely different understanding of money, or of that asset that should function as money, because it is an asset itself. You don't have a claim when you hold Bitcoins. You don't have a claim against another institution on something else, but you have the Bitcoin itself. The Bitcoin is the asset, and sovereign money actually wants to do exactly that. So you would have a asset that is created by governments, that is not a claim on an institution, so not a claim, not even a claim on the central bank, but it is an asset itself, just like Bitcoin is. However, now coming back to 100% money, that was proposed by Irving Fisher and the Chicago Plan, that is still based in the understanding of money as a liability, and you would still have a claim against the central bank.
Fascinating. I was going to say, so Manuel, which one do you prefer?
I do prefer Vollgeld over 100% money. So the NGO that I'm working for is part of these NGOs that propose this type of monetary system, this Vollgeld monetary system. And I do believe it has a lot of advantages. We don't have to go into detail here, but I think it would be a very much more stable system that we currently have. And we don't need this, the setup of a liability or a claim on an institution that is then backed by, for example, government bonds when you look at a central bank, because this is basically, in German, there's a saying, it's from the left pocket to the right pocket, because if a government-owned central bank buys government bonds, it's basically, well, you could delete that out, because if a government owns the central bank and the central bank buys the debt of the government, who holds the debt of the government? The government itself. So you don't even have to do this, and you could create an asset debt-free and could spend it into circulation, just as Bitcoin is.
I think has to happen is that we have to have some kind of change in the current monetary system, be it like the kind of the end or a restriction to this fractional reserve banking we see in any way, or is it an indirect way via introducing a retail CBDC, which actually, as we discussed previously, force banks to be less risky and therefore have lower risks in the current financial system.
Definitely. Yeah, I think I was reading a great book about Axel Weber when he was head of Bundesbank. And I think that one of the reasons he left was because he was trying to argue that it wasn't really legal according to the, I don't know if it's called the constitution of the Bundesbank or whatever the rules were when the bank was set up, that they did not want to buy their own bonds with their own money. I think that was I read that was one of the reasons he got fed up. I don't know. I'm sure you probably, both of you being from Germany, know more about that.
Yeah, and he's actually not the only one. So also Jürgen Stark was in the ECB executive board, also left. I think it was 2011 because he was not in line with ECB monetary policy anymore. And there are also some speculations about Sabine Lautenschläger, who also left ECB just I think this year or last year. So yeah, there are actually also critique is getting more serious, and also more and more German economists really criticize in the stance of the money system and also of the monetary policy, of course.
I think if you create bonds and then banks buy the bonds and then the central bank buys the bonds from those banks, it's maybe not from the left pocket to the right pocket, but it's a third pocket in between that is somehow making this all legal. but it's definitely
Yeah.
just seems like smoke and mirrors when you look at the beauty and some simplicity of a gold standard or a Bitcoin standard, and then you look at how complicated our current monetary system is for really little benefit that's immediately obvious. But
And interestingly, maybe if I can quickly intervene here. Interestingly, when you look at the Bank of England, for example, now with the crisis of the COVID-19, they now decided that they don't even have to. Well, the government doesn't even have to grant or issue bonds to refinance their spending to overcome and to help to overcome this crisis and to help the economy, but that the government itself can actually get the money directly from the central bank. So obviously, this has only been possible due to this unprecedented crisis that we're currently in. However, you see that all this is possible. So the government can actually get the money directly from the central bank as well. I mean, one can argue that this is good, one can argue that this is bad, but I believe that we currently see a lot of movement in this field because obviously when you want to cope with such a strong crisis and when you decide that governments should help their economy, and in the current money system they do have to get indebted in the markets and issue bonds and get the money from somewhere else, then you obviously also have the alternative that they could create the money themselves and just spend it into circulation and help the economy.
But I wanted to go back to the image that you made, figure 1, the typology of programmable monies that is in the paper. And I think that it's nice that you've distinguished between central bank digital currencies and private organization issued monies. I think when I first saw this diagram, I was thinking to myself, well, some countries have private central banks like the US, and some countries don't have private central banks like the ECB in Europe. And on the other hand, I was interested to see that you've broken it down into wholesale, retail, and the additional machine CBDC. And then you've discussed various types of those types of central bank digital currencies. My question is, on this diagram, is that you have distinguished between regulated stablecoins and unregulated stablecoins. And your regulated stablecoins, you include coins like JP Morgan coin. Now, on your unregulated entities, you include coins like Tether and TrueUSD. And my question is, wouldn't you say that these are still regulated?
Yeah, I see your point. I think this is again a question of the claim, right? So if we think about Tether, I mean, as you know, there's lots of discussion going on if Tether is really 100% backed by the respective deposits, and in this case, US dollar, right? And this is something we really do not know for sure. And Tether is not, or the association in the background is not really a regulated entity as far as I know. And if you think about, for example, JP Morgan coin, I mean, this coin, of course, has a very different use case, but what this actually is, it's a 100% backing of some e-money, which exists in the JP Morgan system. So it's actually commercial bank money. And what we know for this project, and also for some in Germany, some startups have conducted, and also the Commerzbank, is that they actually use their e-money license for that. So they are regulated by some e-money license regime as well. And this actually implies from a legal perspective that this money has to be, these tokens have to be backed 100%, because this is actually a prerequisite of this e-money license application. And this is actually what we meant with regulated and not regulated entities, so that we can really be sure that these coins are 100% backed. Or not in the, maybe, I don't want to judge that, but maybe not as in the case, possible case of Tether.
Okay, I completely understand. Yeah, I was reading another paper on stablecoins where it's a paper by Pernes et al., and it came out last year, and it was discussing how even coins that say they're 100% backed actually probably are just like Tether, not fully backed, because the reserves are held in a bank and the bank doesn't have full reserves. So I thought it was a pretty funny way to argue that Tether actually wasn't that bad, because even true USD or USDC or any of the other stable coins, unless the money's held in a vault in physical cash, then they're also
Exactly.
not
I mean,
not fully backed.
obviously, of course, those are not backed by reserves or by central bank money. But I think a very big step is if you can really show and that you are really obliged, for example, by this e-money license, to hold all the funds that you issue, for example, then these stable coins, 100% backed by deposits in the bank account, so that in the emergency case that all of the holders of that stablecoin could actually withdraw their money in the sense of bank money, right? So bank deposits, because we are living in an economy that is based on bank deposits. I mean, this basically is money, right? It's not backed 100% by central bank money or by physical cash. However, we use it as money. So I guess since we use it as money, it is money, right? Because we trust in it. We think it is money. It is a store of value and so forth. So these e-money licensed institutions, for example, Monerium in Iceland. There's another German startup, Cash on Ledger, that also work on an e-money license. When you hold this stablecoin, then you actually know that those are regulated institutions because they have this e-money license, and they have to report about their balance sheet, about their risks and so forth, and they rely on regulation. However, when you look at Stasis and Tether and TrueUSD and whatever you want to call them, you don't have that on your side when you hold the stablecoins, and that's why we believe those can be labeled as unregulated entities.
Okay, so just one final question before we finish up this great conversation on stablecoins and central bank digital currencies. Now, a topic in the literature that you also discuss in this article is that if we can directly hold reserves with the central bank, there could potentially be a bank run on the local commercial banks. And you mentioned a couple different ways that this could be mitigated. Could you just explain a few of those?
Sure. If it's okay, I will start, Jonas.
Sure.
So we just talked about the fear or the potential leading forces to a 100% money system in which all the funds flow out and are transformed into CBDC. Well, there are now in the literature I would say two different types of ways how you could prevent that. One of them has been put forth already in 2018 by the Bank of England by one author called Michael Kumhoff, and he proposes that you would actually prevent the direct conversion in the primary market, so at the commercial banking level, from bank money, so bank deposits, into CBDC. And that basically the open market operations of the central bank are opened also to non-banks. So currently, how do the open market operations work? Central banks buy securities from commercial banks and debit the funds in central bank reserves in the account of the commercial bank, and that's basically what he suggested to widen the access to these operations to the non-banking sector, so that basically everybody could sell government bonds to the central bank and in retrospect receive CBDC. And then in the secondary market, could then look for any potential buyers of that CBDC as an asset you could think it of, and basically by this preventing a direct outflow from bank deposits into CBDC, because actually the supply or the amount of bank deposits in the system would remain the same. It would only shift between the buyer and seller of the CBDC, but you would not be able to withdraw bank money or bank deposits directly into CBDC. That's one approach. The other one clearly is a quantity restriction of the amount of CBDC that you can hold. You could either do a strict quantity restriction so that it's not possible to hold more than a certain amount of CBDC, or, and that was a paper that was released early this year by the ECB by one author called Ulrich Binzeil, and he proposed that you would actually have basically a tiered CBDC system, and that's exactly also an adaptation of the current system which central banks have with commercial banks. So commercial banks have a certain amount of reserves that are where they are granted interest for, and if the amount of reserves are crossing a certain threshold, then the deposits at the central bank, these central bank reserves, are not remunerated anymore with interest. And that's basically what he has suggested for retail CBDC as well. So you can think of it as, for example, when we hold, let's say, 1,000 euros in CBDC, we would get a certain interest rate that follows the market interest rates. But if we crossed that threshold, then we would get a zero or even negative remuneration on that amount of CBDC, thereby preventing a strong outflow of bank credit into CBDC. And those two possibilities are currently discussed. To the best of my knowledge, there have not been any other systems introduced or discussed, but I quickly wanted to add those.
Yeah, maybe one addition. So I think there is also a third possibility, which is but it's very similar to the Binzeil idea. It's just actually imposing a limit on CBDC, so a strict limit, so that you're, for example, not allowed to actually hold more than a specific euro amount in CBDC. And this would also, of course, decrease the risk of disintermediation, because then people would still use banks for loan, etc. And what I wanted to stress as a last point here is that this aspect of financial stability is actually, I mean, it's of course very, very important. And ECB, in all its recent publications, states that a CBDC will only come if it does not threaten financial stability. So all of the presented solutions, I think they are not perfect in the sense that they are not so easy to implement. So if we have the first one, that bank deposits and CBDC cannot be exchanged one by one, this of course is difficult for the clients to get them to understand why this euro is not the same worth as the other euro. And also this two-tiered interest rate system I find very intriguing, and I really like the idea. But it's really an open question if the system can really easily be implemented, or if it in the end will just be a solution which might be just a cap on CBDC, so that people do just use this CBDC in a small amount and therefore not threaten banks. But also here, lots of research is going on. I'm also currently writing a paper about how largely disintermediating effects of a CBDC introduction to banks might be. So there is really lots of research going on, and I think there will also be more concepts presented the next few months and also years.
Oh, it's fascinating. I mean, I think listening to both of you, I wouldn't want to be particularly working at a bank right now. I think disintermediation has been a trend for even before crypto, and I think that pressure is getting even stronger, and there might be some efforts by the central banks to kind of hold the tide back. But I think a lot of people are looking for a different place to store their savings. So this is a great information in this podcast. I really learned a lot from both of you. You both are obviously experts on this topic, and I'm looking forward to following up on the future papers that you publish. I will definitely link the paper that you published on Medium in the show notes. And if the listeners want to follow you, where can they find you?
Sure. So they can find me on LinkedIn. I'm actually quite active there. I'm also on Twitter. On Twitter, and I'm writing on a very regular basis. So I think once or twice a month on Medium. So actually, if you're interested in lots of different DLT topics, CBDC, Libra, or some general topics, then of course your listeners are very welcome to follow me and also get in touch with me.
Yeah, same applies for me. I'm not a Twitterer, but you can follow me and find me on LinkedIn, where I also write and post about all these topics, but also about economic and market topics. And looking forward to get further into touch, maybe also with you. And thanks a lot for this great opportunity to talk in your podcast.
Thanks for coming on the Academic Blockchain Podcast.
Thank you for listening to the Blockchain Academic Podcast by the Crypto Research Report. We hope you found this episode to be informative. Thank you to our premium sponsors, Coinfinity and Falcon Bank. For more professional financial analysis of cryptocurrencies, blockchain technology, and the weekly Crypto Research Portfolio newsletter, please visit the website cryptoresearch.report.